Why following the rules keeps you poor? Let's be honest. You've been sold a story about money. A story that sounds safe, responsible, and like the smartest thing you could do. It's been passed down for generations. Preached by every financial guru on TV. And it's the backbone of almost every personal finance book out there. The story is this: save your money, get out of debt, and dump everything into a 401k for 40 years. And you know what? People are listening. In 2025, savers are putting away a combined 14.3% into their 401ks, which is a record high. That is the playbook for being comfortable. It's the path to a quiet retirement in your late 60s. But it is not the road to true financial freedom in your 30s or 40s. It's a set of rules designed to build slow, safe, incremental wealth. It's like taking the stairs when an elevator to the penthouse is waiting for those who know where to find it. In this video, I'm going to show you the playbook the wealthy actually use, and it starts by rethinking every single one of those rules. We're going to take apart the old playbook, the one that keeps 99% of people in a cycle of working, saving, and waiting. Then, I'm going to hand you the new playbook, the 1% use to build massive, life-changing wealth. This isn't about luck or trust funds. It's about a completely different mindset and strategy. It's about understanding that the financial advice for the masses often leads to average results. Today, you get the blueprint for something more. Stick with me, because what I'm about to share will permanently change how you see money, debt, and your own power to build a fortune. The problem: the old playbook and its flaws. So before we start breaking rules, let's get clear on what they are. The old playbook, the one sold as the key to financial security, goes like this: go to school, get a stable job, work hard, climb the ladder, budget everything, stop buying coffee, save 10 to 15% of every paycheck, pay off all your debt, especially your mortgage, as fast as you can. Max out your 401k in a diversified mix of stocks and bonds. Wait 40 years for compound interest to work its magic. Retire at 65 and hope the money lasts. Look, on the surface, this sounds smart, it's responsible, and for a lot of people, it's the only strategy they've ever heard. It's the mindset of the middle class, a focus on stability and security. The goal isn't really to get rich, it's to not be poor. It's a strategy built on earning and saving, where risk is the enemy. The main flaw here is that this is a game of defense, not offense. It's about protecting what you have, not creating something huge. It's a straight line. You trade your time for money, save a little piece of it, and hope it grows faster than inflation. But the wealthy don't just play defense, they play offense. They aren't just trying to preserve their money, they're actively trying to multiply it. They understand a truth the old playbook ignores. You can't budget your way to $1 billion. You can't save your way to a fortune. And you definitely can't get there by playing it safe and following the herd. The old playbook was designed for a world of pensions and lifelong careers at one company. Today's world is one of rapid change, economic swings, and huge opportunities for those who think differently. The rich get this: they aren't just saving, they're investing and multiplying. They see money not as something to be hoarded out of fear, but as a tool to be deployed for growth. Following the old playbook today is like trying to win a Grand Prix in a station wagon. You might finish the race eventually, but you'll be lapped by everyone who chose a faster car. It's time to get behind the wheel of the race car. And it starts with breaking the first rule you ever learned about money. Rule to break number 1. The myth of saving your way to riches. The first, most sacred rule we're all taught is: a penny saved is a penny earned. We're told to save, save, save. The problem isn't the discipline of saving, that's a great skill. The problem is believing that saving is the main way you build wealth. It's not. The misconception: saving your money diligently will make you rich. The truth: saving is for short-term security. Wealth is built by investing for cash flow and growth, not by stockpiling cash. Let's be real. Just letting cash sit in a standard bank account is often a losing game over time. Inflation is the silent thief that eats away at your purchasing power every single day. While some high-yield savings accounts or CDs might keep pace, they are not wealth creation engines. You're running on a financial treadmill. and the speed is slowly getting turned up. The standard mindset is to see money as something to be earned and then saved. You trade your time for a paycheck. And the goal is to build up a pile of cash. The focus is on the amount of money you have. The rich, however, think differently. They care less about the size of the pile and more about the velocity of their money. Velocity is just a fancy word for how fast you can put a dollar to work, get it back, and send it out to work again. A saved dollar is a lazy dollar. An invested dollar is your hardest working employee. It goes out, finds more dollars, and brings them back to you. The wealthy focus on turning their income into assets that generate more income. They play to win, not just to not lose. They want assets that produce cash flow, money that shows up every month whether you clocked in at a job or not. Think rental income, stock dividends, or business profits. Imagine you save $100. In the old playbook. That's amazing. You guard it. Maybe put it in a high-yield savings account. It feels safe, but it's asleep. Now, let's use the new playbook. That $100 isn't a safety net, it's your launchpad. It's the down payment on a $400 rental property that brings in $1 a month in positive cash flow after all the bills are paid. You still have an asset, but this one is also paying you $12 a year. Your invested dollar is working. Your saved dollar was sleeping. The goal isn't just to save up a pile of money to live on when you're old. The goal is to build a machine that produces enough income to cover your lifestyle forever. That's real freedom. So, the first rule to break is to stop seeing saving as the final destination. Saving is just a temporary parking spot for your money on its way to a job. Build a 3 to 6 month emergency fund. Absolutely. That's your security. But every dollar after that needs to be put to work. You're the CEO of your money. And it's your job to put your capital to work. Stop worshipping the savings account and start building your cash-flowing empire. Rule to break number 2. All debt is bad. If saving is the hero of the old playbook, then debt is the villain. We're taught to fear it, run from it, and pay it off with incredible urgency. Being debt-free is spoken about like it's a spiritual achievement. The misconception, all debt is created equal, and it should all be eliminated. The truth, there's bad debt and good debt. The rich master the use of good debt to build wealth far faster than they ever could with just their own money. This is one of the biggest secrets separating the wealthy from everyone else. The average person sees debt as a weight. The wealthy see it as a lever. Let's quickly define our terms. Bad debt. This is debt used for things that lose value. High-interest credit cards for a shopping spree, a loan for a vacation, or financing for a new car that drops in value the minute you buy it. This debt makes you poorer. And the old playbook is 100% right, get rid of it. Good debt. This is debt used to buy assets that make you money or grow in value. It's a loan where the thing you buy with it generates more income than the debt costs you. This is the debt the rich use to amplify their returns. Here's how it works. Let's go back to our real estate example with your $100 cash. Old playbook, no debt, You buy a $100 property for cash. After expenses, it makes you $500 a month, or $6 a year. That's a 6% return on your cash. Solid. New playbook, good debt, You use your $100 as a down payment on a $400 property. You borrow the other $300. After paying the mortgage and all other expenses, you still make $500 a month, or $6 a year. Wait, the cash flow is the same, so what's the difference? The difference is everything. Scale and control. With debt. You now control a $400 asset instead of a $100 one. If the property value goes up by 5%, that's a $20 gain on the $400,000 property. Not a $5 gain on the $100,000 one. Your net worth grew by an extra $15, all while your tenant was paying down your loan. Tax breaks. This is huge. The interest you pay on an investment loan is a tax-deductible expense. You also get to claim depreciation on the property, which is a non-cash deduction that can lower or even wipe out your tax bill on the income. Risk management. Now. This is critical. Leverage is a double-edged sword. While the wealthy use it, Many also work to limit their leverage because it magnifies losses just as easily as it magnifies gains. This isn't about recklessly borrowing as much as you can. It's about taking on smart, calculated debt where the potential return on the asset is comfortably higher than the cost of borrowing. The fear of all debt keeps people thinking small. It limits you to only what you can save yourself. By learning to tell the difference between good and bad debt, you unlock the ability to scale your wealth building far beyond your own paycheck. You stop thinking like a consumer and start thinking like a bank. We're about to hit the third rule the wealthy ignore. And it's one of the most counterintuitive ideas in all of finance. But before we do, if you're getting value out of this and your wheels are starting to turn, do me a favor and hit that like button. It really helps get this message out to more people who need to hear it. And if you haven't yet, subscribe and turn on notifications, because you won't want to miss the financial secrets we share every single week. Now, let's talk about diversification. Rule to break number 3, diversify. 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 This is the mantra of the entire financial industry. Don't put all your eggs in one basket. Spread your money across hundreds of different stocks and bonds to lower your risk. The misconception. Wide diversification is the best way to build wealth. The truth. Concentration builds wealth. Diversification preserves it. Warren Buffett once said, "Diversification is protection against ignorance." It makes very little sense for those who know what they're doing. This isn't about being reckless. It's about knowing the difference between building a fortune and protecting one. Diversification is designed to reduce risk. By spreading your money so thin, you ensure that no single company's failure can wipe you out. That's true, but it also ensures that no single company's massive success will make you rich. By its very nature, diversification pretty much guarantees you average returns. When you buy an S&P 500 index fund, you are accepting mediocrity in exchange for safety. But think about it. How many people do you know who became extraordinarily wealthy just by owning index funds? Fortunes are built through focus. Jeff Bezos didn't get rich by diversifying. He poured everything into a little thing called Amazon. Bill Gates went all in on Microsoft. They found one thing they understood better than anyone else, and they concentrated their efforts. This is the path to exponential wealth. It requires you to become an expert. Instead of knowing a tiny bit about 500 companies, you learn everything about one or two. It could be a specific industry, a type of real estate, or your own business. It's about developing an edge through deep knowledge. The problem with what some call diversification is that it gives you a false sense of security. You own so many things you don't truly understand any of them. Your few great ideas get watered down by all the mediocre ones. So what's the right way to think about it? Build with concentration. While you are in the wealth building phase of your life. Focus is your superpower. Find your niche. Build your business. Master your corner of the real estate market. This is where you can generate the huge returns that create real wealth. Preserve with diversification. Once you've won the game once the fortune is built, then it's time to diversify. This is when your main goal switches from wealth creation to wealth preservation. You sell off pieces of your concentrated position and spread the money out to protect what you've built. Most people are told to diversify from day one because the system assumes you are, and will remain, an amateur investor. It's a strategy that protects you from your own lack of knowledge. The wealthy choose to become knowledgeable instead. They understand that to get better than average returns, you can't be an average investor. Get rich first, diversify later. Rule to break number 4. Your house is your biggest asset. This idea is woven into our culture. Owning a home is the American dream. We're told that paying rent is just throwing money away, and that your home is the best investment you'll ever make. The misconception. Your primary residence is an asset. The truth. To build wealth, you need to see your primary residence as a liability, not an asset. This idea was made famous by Robert Kiyosaki in Rich Dad Poor Dad, and it's a mindset shift that changes the game. To get it, you have to accept his simple, powerful definitions. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. It's all about cash flow. Now, look at your home through that lens. Does it put money in your pocket each month? No, it does the exact opposite. Money flows out of your pocket for the mortgage, property taxes, insurance, repairs, maintenance. The list goes on. Even when the mortgage is gone, you're still paying taxes, insurance, and for the new roof or water heater. Your home is a constant expense. By this cash flow definition, it is a liability. Of course, a bank will tell you your house is an asset. And for them, it is. Your mortgage is an asset on their books because it puts your payments into their pocket every month. This doesn't mean you shouldn't buy a home to live in. It means you have to stop thinking of it as your main investment. The danger is that people pour all their money into their home, thinking they're investing, when they're really just increasing their expenses and tying up capital in something that doesn't pay them. The wealthy think about it differently. They buy investment properties first. Maybe they buy a duplex, live in one side, and rent out the other. The rent from their tenant covers the entire mortgage. Suddenly, that property has flipped from a liability to an asset. It pays for itself. The goal is to buy cash-flowing assets first, rental properties, dividend stocks, a business. Then, you use the cash flow from your assets to pay for your liabilities. Like your dream home, your investments buy your house for you. The average person works a job to pay for their house. The rich build assets that pay for their house. Yes, your home might go up in value, but appreciation is the icing, cash flow is the cake. Focus on the cake. Stop treating your home like the crown jewel of your portfolio. See it for what it is, a place to live and a wonderful lifestyle choice. But an expense. Build your portfolio of true, cash-flowing assets first. Rule to break number 5. Play it safe. This last rule of the old playbook is the most sneaky because it feeds on our deepest fears. Play it safe. Don't take risks. Stick with what you know. This advice is a recipe for an average life. A life spent on the sidelines. The misconception. The safest path is to avoid risk and stick to traditional stocks and bonds. The truth. The biggest risk is not taking one. The wealthy build fortunes by taking calculated, intelligent risks that most people are too afraid to consider. The average investor's portfolio is almost all public stocks and bonds. It's the safe approach. But the portfolios of the ultra-wealthy look very different. Studies show that high net worth investors often allocate a significant part of their portfolio, sometimes 30 to 40% or more, to alternative investments. These are assets outside the traditional stock market, like private equity and venture capital, investing directly in private companies. Real estate, not just a house, but large apartment buildings or commercial properties. Private credit, becoming the bank and lending money directly to businesses. Hedge funds, using sophisticated strategies to aim for returns in any market. Tangible assets, things like fine art, collectibles, or intellectual property. Why do they do this? They're looking for returns that aren't tied to the daily whims of the stock market. They know the biggest opportunities are often in less crowded, less efficient markets where specialized knowledge gives them a huge advantage, while everyone else is glued to the S&P 500. The wealthy are investing in a private tech company that could be the next giant, or buying a portfolio of cash-flowing properties. This requires a new relationship with risk. Most people are risk-averse. They see the chance of loss and run. The rich are risk managers. They see the chance for reward and figure out how to minimize the downside. They look for asymmetric bets, where the potential upside is many times greater than the potential downside. A huge part of this is mastering something the average person complains about: taxes. The rich are obsessed with after-tax returns. They use legal structures like LLCs and trusts, and strategies like 1031 exchanges in real estate to defer taxes, sometimes indefinitely. They see the tax code not as a burden, but as a book of incentives to be used to their advantage. Playing it safe guarantees you'll never have extraordinary results. Breaking this rule doesn't mean being reckless. It means getting educated. It means investing in your own financial knowledge so you can understand opportunities beyond the vanilla world of Wall Street. The biggest risk you can take is to let fear choose a future of mediocrity for you. The mindset shift, the foundation of all wealth. We've talked about breaking 5 rules. But none of these strategies will work without the most important piece: a massive shift in your mindset. Wealth is a psychological game first and a numbers game second. The real difference between the rich and everyone else is in their beliefs about money. The old playbook is built on asterisk scarcity. This is the belief that there's a limited pie and you have to guard your slice. It's a worldview based on fear. Fear of loss. Fear of risk. It leads to playing defense. The new playbook is built on asterisk abundance. This is the belief that the pie is always growing. That opportunity is everywhere. And that money is just a tool for growth. It's a worldview that asks, how can I make this work? Instead of saying, that will never work. This isn't just fluffy positive thinking. It's a practical change in how you operate. They see money as a tool, not a target. Asterisk money is a resource to be used strategically. Like a hammer, the wealthy separate their self-worth from their net worth, which allows them to make unemotional, logical decisions. They choose long-term vision over short-term gratification. The wealthy are masters of delayed gratification. They are willing to sacrifice comfort today for incredible freedom tomorrow. They are obsessed with learning. They know their education didn't end with a diploma. They are always reading, joining masterminds, and attending seminars. They invest in their own knowledge because they know their mind is their greatest asset. They believe they create their life. The scarcity mindset makes you feel like life happens to you. The abundance mindset is about taking total responsibility. The rich believe, I create my life. They don't wait for things to happen, they make them happen. They value their network. The rich understand that who you know is just as important as what you know. They actively build relationships based on trust and mutual value, because their network provides access to deals and knowledge that most people never see. Adopting this mindset is the hardest part, but it's the only part that really matters. Without it, you can have the right strategies and still fail. The rules we broke are the what. This mindset is the who. You have to become the person who can run this playbook. For years, you've been playing a financial game with a rulebook designed to keep you safe, but never let you truly win. The rules were simple: save, fear debt, diversify into average, call your house an asset, and play it safe. Today, we tore up that rulebook. We've replaced it with the playbook used by people who don't just participate in the economy, but shape it. Instead of just saving, you will invest for cash flow. Instead of fearing all debt, you will learn to use good debt as a powerful tool. Instead of diversifying into mediocrity, you will build your fortune through focus. Instead of calling your house an asset, you will build true assets that pay for your liabilities. And instead of playing it safe, you will learn to take smart, calculated risks. But most importantly, you will adopt the abundance mindset that makes it all possible. This isn't the easy path. It takes courage, education, and going against the grain. But the path to exceptional wealth is never crowded. The playbook is in your hands now. The only question is what you'll do with it. So, I'll end with a question for you. What's the one rule you're going to break first? Let me know in the comments below. If this video opened your eyes, we've only scratched the surface. Click here to watch my next video on the 7 income streams of millionaires to start building your own cash flow machine. And if you're serious about taking action, make sure you subscribe to this channel for the strategies you won't find anywhere else. Thanks for watching. Now go break some rules.